While there are similarities, in this video we highlight some significant differences between the summer swoons of the past 2 years and the present day. The video opens with some subtle but potentially important differences between the present day and July 2011. We also examine current CCM model readings, potentially bullish signals from commodities, numerous charts, and daily DeMark counts for bonds and stocks. As always, with a fragile situation in Europe, it is extremely important that we remain flexible and open-minded. This is a daily chart of the S&P 500 index. We're comparing the summer swoons in 2010, 2011, and 2012. The red line here is the 200-day moving average. The blue line is the 50-day moving average. The point of the exercise, we'll focus on the 200-day here. If you're familiar with technical analysis, you'll agree that a 200-day moving average tends to be a good long-term bull-bear demarcation line. Markets, when price is above the 200-day, tend to be healthy. When they're below the 200-day, bad things tend to happen. Above, healthy. 2010 summer swoon, you can see we blew right through the 200-day moving average here, and then after that, it acted as resistance. 2011 went through the red line, the 200-day moving average, like a hot knife through butter. Came up here, it acted as resistance. What once was resistance here and here is now acting as support. So you can see the summer swoon in 2012 is quite a bit different than these relative to the 200-day moving average. You can make an argument that last year we did something similar here. I would argue that this bounce here is quite a bit different than this bounce here in 2012. In 2011, we never made a significant lower low. We never took out this low here. In 2012, we took out this low, this low, this low, and this low. So this corrective process here is quite a bit different than this leg down here. The other thing is, on this bounce, this is a much weaker bounce technically than this bounce. Why is that? There's no important or significant higher high made here. This is a lower high relative to this high. Come over here, and we've made really 1, 2, 3 significant higher highs and 1, 2, 3 significant lower lows. This is a fully established uptrend off of this bounce here, where that's not the case here. Now let's add some lines to the picture. This green line illustrates the concept a little bit more clearly. 2010, below it we're in crisis mode. Once we get back above this green line here, good things happen. Below it in 2011, crisis mode, broke above it here, which is a good sign, and eventually got back above the green line here and had a nice little run. The difference here is, instead of breaking through it and going into a longer term crisis mode, in 2012 thus far we have held above it and we have an upward sloping 200-day moving average. Nothing says we can't get some weakness here, but as long as we hold above this green line, probably tells us that the bulls are in control. Below it, the bearish case can pick up steam as it did here and here. Using this blue line, when the market was above the blue line, it tended to hold up and good things tended to happen. We broke below the blue line here, bad things happened. Here, the blue line acted as resistance. Here's a bullish breakout from the blue line. We came down here, what once was resistance here is now acting as support here. So far, holding here at this blue line confirms this bullish breakout as long as this holds here. This purple line here acted as resistance, resistance, resistance. We had a bullish breakout here, and you can see we came back and basically retested the purple line right in this area here. What once was resistance here, here, and here is now acting as support. Point of the exercise is this was relatively strong support with the intersection of these 3 lines and the upward sloping 200-day moving average. This was one of the reasons why we started to buy right in this area and redeploy cash. If we come back down, the 200-day, which is currently at 1313, the green line, the blue line, and the purple line could act as support again on further weakness. Another point, here the 50-day moving average turns up, 50-day turns up here. Both of those are foreshadowing this move higher here. 50-day moving average turns up here. Eventually, it leads to good things. Here, if you look closely, you can see the 50-day moving average in the present day is trying to turn up, which is similar to this point here. If you read our blog Short Takes, you know that we've used this reference point in 2010 and this reference point here, B, in 2011, to see where we are in 2012. Why would we use those? This is the move off the bottom, but after point A, we had a significant pullback. After point B, we had a significant pullback. Once we cleared the hurdle here, good things happened. Once we cleared this hurdle here, good things happened. So now we'll check in and see where some technicals are, as well as our three market models relative to point A in 2010 and point B in 2011. In the previous chart, we looked at point A in 2010, point B in 2011. In this table, we'll use RSI as an example. These are hurdles that you'd like to cross to feel better about passing what could be equivalent to a point A or point B in 2012. In 2010, at point A, RSI hit a high of 62, and then the market pulled back before going on to make higher highs. In 2011, at point B, RSI hit a high of 65 before the market reversed, significant correction, and then went on to make higher highs. We'd like to see if we're, from a probabilistic standpoint, past point A and point B, and instead of correcting and then going on to higher highs, that we might be moving higher from here. RSI, the maximum amount that we've hit on the current rally is 62, which does not exceed either of these levels, meaning the present day may still look like point A and or point B as far as RSI is concerned. Using our market models, the news is a little bit better. The 80-20 correction index, the CCM market risk model, and the bull market sustainability index. In this table here, there are 10 hurdles that we're trying to cross to feel better about exceeding a similar point to A and B. Now we've crossed 70%, or 7 out of those 10 hurdles, which is still a mixed bag, but it definitely leans towards the bullish end of the spectrum. After a pullback here, we could go on to make higher highs relative to what we've done. We'd feel a lot better when these two levels are taken out, and this level here is taken out as far as the risk model goes. This is a chart that we've looked at several times in the past month or so, maybe 6 weeks. This is a basket of commodities, the CRB index relative to the S&P 500 index. A few weeks back, we hypothesized that when this trend line here holds, that tends to be good for risk assets. When you're looking at this ratio, when it's rising, commodities are stronger than stocks, and when it's falling, stocks are stronger than commodities. A few points here. This is a massive bullish engulfing candlestick. This candlestick here engulfs the red body of this candlestick. That tends to be bullish. In this case, it appears to have worked. Commodities have picked up steam significantly versus stocks. Going back again to the analogy in the summer of 2011, where the stock market popped and then came down in the summer, I'll argue here that this move in commodities, these candlesticks here, are much more attractive and bullish than these candlesticks here, which to me says risk on has a much, much better chance of succeeding with these candlesticks than it did in the summer of 2011 with this indecision and these candlesticks. The other things to note here, we said that RSI here, this was a good sign that we saw a break, and we said it often foreshadows a break of this downward sloping trend line. Well, you can see we have the break of the downward sloping trend line. Good question would be, what happened last time something similar happened. So we've got a downtrend that's clearly broken here now for 2 weeks. This is similar here. We break out right here, and we drew this green line going down to let you see what happened. RSI on this chart stayed above 50, which we've argued in the past is bullish for commodities relative to stocks. This is the CRB index here. You have the breakout here. Take the green line down. Commodities did very well on their own. This is just a basket of commodities, not relative to anything. Did well to the right of the green line. And the stock market was in the process of bottoming in 2010. Here is Ben Bernanke's Jackson Hole speech, and stocks took off after that. We do have a Fed meeting coming up in roughly a week, and it appears that the commodity markets are expecting Uncle Ben to pull the trigger on something or to at least hint at something going forward. Here, all he had to do was hint at QE2. It wasn't announced until here in November. So we don't need the Fed to announce QE3. We just need a hint at QE3. This chart from where we sit leans bullish for both commodities and leans also towards a bottoming process for risk assets similar to the summer of 2010. This is also a chart that we've shown numerous times in the past. This is a monthly chart of the S&P 500 with the rate of change here. When the rate of change is above the center line here, the S&P 500 tends to perform well. Here's a bearish break with the rate of change. The S&P 500 performed poorly. Currently, we're above the zero line, which tends to be bullish. Notice here in the summer swoon of 2010, when we found a bottom, the market didn't have any monthly readings that were positive. Every month was down here. Same here, every month was down. As soon as we got a positive monthly reading in the S&P 500, we had already hit a bottom, and that was part of a bottoming process. Once we became positive from a monthly perspective, we had found a bottom. If that trend holds, that's good news. June of 2012, you can see here, the S&P 500 was up 84 points in the month of June. So you can make an argument that this looks similar to this and to this. We also have rate of change holding here near the center line. Stocks did well on a monthly chart. Holding here near the center line, stocks did well on a monthly chart. We're holding here now near the center line, and we're well above it. This period looks similar to this period and this period. This is another chart of support and resistance. This is a monthly chart that we've looked at in the past. We hypothesized that when the market stays above 1354, that 1440 stays in the picture. We closed Friday of last week at 1362. You can see that here. In isolation, looking at this candlestick, it's a doji roughly, which means hesitation. If you looked at that in isolation, you would say that's bearish. However, looking back in recent history, here's a similar candlestick, positive outcomes, similar candlestick. This candlestick here looks similar to last week, bullish outcomes. These two candlesticks here look similar to last week, bullish outcomes. By no means does that say we're done with any kind of corrective process, but in isolation, that candlestick probably isn't as bad as it looks. Last week, we said the weekly chart of VEU, the All-World Index, sans the United States, could go either way. This is a daily chart, just to show the confusion in the markets. This is the 200-day moving average in pink. It's turning up in a bullish manner. This green is the 100-day moving average. It's rolling over in a bearish manner. The blue line is the 20-day moving average. Price is holding there roughly, and it's turning up in a bullish manner. But then when we come in and look at the 50-day moving average, it's bearish. So we've got a very, very confused and mixed market. The good news is this pink trend line is still holding. We've got potential support here and here. But again, this market could go either way. Here is the weekly chart that I just referenced of VEU. This is a mixed bag. 22-week moving average rolling over bearish. We're still below this downward sloping trend line, bearish. MACD histogram still ticking up, potentially bullish and foreshadowing potentially a bullish cross. We haven't had that cross yet, but we appear that we're close. This leans bullish, as long as it stays in this form. Red above green on ADX, bearish. However, black is rolling over, which tends to be bullish. Mixed bag on this chart. We'll just have to see how it plays out. Now we're looking at a weekly chart of the VIX. Let's focus on PPO. This is a bearish PPO cross in 2010 for the VIX, or the fear index, which tends to move inversely from the stock market. You get the bearish cross on a weekly chart. This is the S&P 500, which was already finding a bottom here and in a bottoming process. After this bearish cross for the weekly VIX, stocks did well. Similar situation in 2011. You get a bearish cross for the VIX on a weekly chart of the S&P 500. A bottom has already been put in. You still get a scare after it here, but after this bearish cross for the VIX, stocks did well. We've got a bearish cross here that has formed. As long as it holds, that tends to be bearish for the VIX and bullish for the stock market. This is a weekly chart of the Vanguard Total Market Index. Just appeared to be a little interesting that the two previous weeks were negative, and last week, even though it felt terrible on Friday, was positive and shows some indecision. So this is very indecisive here, and if you didn't know what happened on Friday, you'd probably have to say that these three candlesticks lean bullish. However, we would not be surprised to see additional weakness after what we experienced on Friday. A similar situation with the NASDAQ, two weak candlesticks. Last week's weekly candlestick didn't look as bad as this one or this one. We said earlier in the video that we have a confused market. Here's the weekly chart of TLT, so let's think of this as the risk-off chart. The weekly candlestick here doesn't look great either. In fact, if you were taking a technical analysis test and you asked whether you wanted to own a market that had a candlestick last week like VTI's, stock markets, or this candlestick, I'd pick VTI, which seems a little odd with the way that we finished on Friday, but that's not a great looking candlestick. And the previous candlesticks that we looked at for the NASDAQ and VTI are really more attractive than this one. No question, on Friday we were weak, and it wouldn't be shocking if TLT went on to make a higher high. Let's look at some DeMark charts and see what might happen if that's the case. Now we're looking at a daily DeMark chart for TLT, the long-term Treasury bond ETF. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Takeaways here quickly. Above this green line, all things being equal, leans bullish. Says that this target up here at 134.43 remains realistic. The concerns would be, this is just regular RSI. You can see we made a high here and we're approaching that high here. This is a bearish divergence on the daily RSI. And if we look at a combo DeMark count, we have a 13 that's still waiting for us here if we get a close above 130.36. So this is a mixed bag. If we do get the 13, the stop loss level or the risk level may not come in until somewhere in this area up here. We'll just have to see what happens next week. That will determine where that risk level would come in if we do indeed close above this level here, which is 130.36 on TLT. Now we're looking at a daily DeMark chart of the S&P 500 index. A few points here. This is a DeMark trend line that we closed below. That leans bearish in the short term. If we move down, you've got potential support from DeMark indicators between 1342 on the S&P 500 and 1341 and change. If this area here didn't hold, here's a potential area of support around 1334. And if that doesn't hold from a propulsion perspective from DeMark, 1302 comes into play. We did mention last week that we did have an exhaustion count of a 9 and 13 here that worked extremely well. If we want to look at some other counts, DeMark has 4 counts that we tend to follow. There's a combo count, a sequential count, an aggressive combo, and an aggressive sequential. They all work in similar ways. The settings are just a little bit different. Let's look at the standard combo count. It's only on a 9-10. To get to a 13, you would actually have to close below this 10 for 1, 2, 3 more days. That tells you it leaves the door open to lower lows on the combo count. The sequential count is on a 9-12. These asterisks tell you that it's a deferred count. To get the 13, you would need to have an intraday move below the closing price here on the 8 bar of 1278 and change. So the DeMark counts do leave the door open for significant weakness. The good news, if you're a bull, is if we come down in this area, we will have potentially 913s waiting to greet us. One of the reasons why we believe we may see more weakness in risk assets is a daily chart of TLT here. This is a 3 candlestick pattern here known as a morning doji star. All you really need to know is these 3 candlesticks tend to be bullish. If you look at SPY, you get just the opposite. You get what's known as an evening star. This candlestick, and this candlestick, they tend to be bearish. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.